$100 silver isn't a bold call. It's what the market backs into when the plumbing can't clear the stress any other way. Not because everyone suddenly believes in a number, and not because a talking head willed it into existence, but because the moment deliverable supply tightens while paper exposure stays enormous, price becomes the only release valve. And right now, there are forces actively trying to frame this as a fleeting mania. Bubble, speculators, it'll mean revert. While the more important signals are flashing in places most people never look. The payoff in this video is simple. By the end, you'll know the one hidden constraint that turns $100 from a prediction into a consequence. You'll know why the calendar is doing more damage than the headlines, and you'll have a next 2 weeks checklist with the levels that matter and the conditions that would break this entire setup. Because if one specific pressure point doesn't ease, the math changes. Start with what just happened, because markets confess in their speed. Silver didn't grind higher in a calm, orderly trend. It detonated upward, printed into the 80s. Reports put it as high as roughly $84, and then it snapped back hard toward the mid-70s in the same breath. That kind of range isn't normal price discovery. That's positioning being forcibly resized. That's leverage meeting thin liquidity. That's the market showing you the edges of its own risk tolerance. And the next detail is the tell. The violent drop didn't come from some new piece of bearish supply data. It came from the mechanics of collateral. When an exchange raises margin requirements into a volatility spike, it's like tightening a tourniquet after someone already started sprinting. Suddenly, anyone running leverage, funds, traders, even hedgers, has to post more collateral or reduce exposure. That reduction is not a debate. It's not a narrative. It's forced selling. And that's exactly what hit. A CME margin hike into year-end conditions, the worst possible timing for calm markets. Because if you're thinking, okay, so it's just a technical washout, you're missing the deeper implication. Forced selling can knock price down even when the underlying stress is getting worse. That's where the real pressure starts. Now add the calendar, because this is not a random week on a random chart. Late December is the season of thin liquidity and hard constraints. Desks are staffed lighter. Market depth thins. Risk limits tighten. Funds clean up books. And right as liquidity thins, the market is walking into a cluster of catalysts. Year-end positioning margin regime changes, and the transition into early January flows. Index rebalances. New allocations, and the inevitable scramble around what actually needs to be delivered versus what can be rolled on paper. That's the why now, not because everyone woke up and loved silver, because the calendar is forcing decisions. And there's a second layer to the calendar that matters even more, policy and trade timing. Reports say China is moving toward tighter export controls starting January 1st. Whether the exact details end up strict or flexible, the point is the same. When the market even suspects a bottleneck at a major refining and export node, the first response isn't a long-term forecast. The first response is a near-term scramble. Buyers pull demand forward. Inventory managers get conservative. The system stops assuming it can always source metal easily next month. And that shift, pulling demand forward, shows up in the one place you can't fake for long, the near-month structure. Because if that one structure flips, the whole story flips. Here's the hidden detail most people never internalize. Silver inventory is not one number. It's categories, and only one category is the choke point. Silver can sit in approved warehouses and still be effectively unavailable. In comics terms, there's eligible and there's registered. Eligible means it meets standards and is stored in approved facilities, but it is not currently designated for delivery against futures. Registered is the deliverable pile, the metal that's actually available to satisfy a delivery obligation without someone deciding to convert it. That difference sounds boring until you realize it's the difference between metal exists somewhere and metal can clear a delivery stress this month. And when the market tightens, registered is the pile that matters. Because if registered draws down while paper claims remain high, price doesn't drift. Price gaps. Let's put numbers to it without turning this into a spreadsheet lecture. A recent CME warehouse report showed total silver stocks around the mid 400 million ounce range, while registered, the deliverable portion, was closer to roughly 127 million ounces. That means the deliverable float is a fraction of the headline total. And that fraction is the pressure point, because the market can't eat total inventory. It can only eat what's deliverable on time in the right form at the right place. The next detail is what flips the whole setup. Eligible can stay high while registered is stressed, and the headlines will still scream plenty of inventory. Meanwhile, the delivery mechanism is tightening like a vice, and if you're only watching spot price, you'll miss the actual fight. Now, I'm not saying inventory is going to zero, and I'm not selling you a cartoonish certainty. What I'm saying is the market's vulnerability lives in that deliverable subset, and the behavior around it is what creates consequence pricing. The easiest way to see that behavior is term structure, whether the market pays more for metal now versus later. In a relaxed market, the future months usually trade a bit above spot because carrying metal costs money. You pay storage, insurance, financing. So the curve tends to slope upward, contango. When the curve flips, when near months trade richer than later months, that's backwardation, and it's the market paying a premium for immediacy, not eventually. Now, backwardation in an industrially relevant commodity is rarely just vibes. It's a stress signal. It means something is bidding for availability. It means someone would rather pay up today than gamble on sourcing later. And that forces behaviors you can predict. If you're short, your carry becomes painful. If you're a manufacturer, your procurement turns defensive. If you're a dealer, you widen spreads because you can't be sure you can replace inventory. But that's not the part that matters most. The part that matters is what backwardation does to paper. Paper markets can roll exposure. They can push problems forward. They can manage risk by buying time. Backwardation is what makes buying time expensive. It turns time into a cost. And once time becomes a cost, the market starts to clear in jumps, not inches. Now zoom out. Why does silver get these violent, emotional-looking swings? Because it sits at the intersection of two worlds that behave differently. One world is macro and monetary, rates, currencies, inflation expectations, risk-off hedging. The other world is industrial and physical, electronics, solar, electrification, data, infrastructure, medicine, and every supply chain that treats silver as a performance input rather than a speculative asset. When both worlds want the same metal, the system doesn't balance politely, it lurches. And lurching is where consequence pricing lives. Here's proof point number one. The margin event itself is a structural stress indicator. Exchanges raise margin when volatility rises, and volatility rises when positioning and liquidity are mismatched. That doesn't tell you up or down by itself. It tells you the market is in a regime where moves are amplified, where small imbalances produce large price swings. And that is exactly the kind of regime where a constraint, like deliverable supply, stops being background noise and starts being the driver. Because if volatility is already high, the threshold for forced behavior is lower. Proof point number two, the warehouse categories and the deliverable ratio. It's not that 400 plus million ounces is tiny in absolute terms. It's that the deliverable slice is the slice that matters under stress, and it is meaningfully smaller. And even within registered, you have another reality. Registered can be spoken for by market participants who intend to take delivery, or it can be used as collateral logic for hedges. When claims concentrate, the effective float shrinks, and the effective float is what the market prices in panic. Proof point number three, the policy just tariff export control narrative isn't important because it's a headline. It's important because it changes procurement behavior. Even rumors of tightened exports can trigger inventory hoarding in downstream industries. It can trigger import surges. It can trigger a scramble for non-Chinese refining routes. And because refining and logistics are slow, a short-term scramble doesn't get solved quickly. If the market has to reroute supply chains, it pays a premium to do it. That premium can show up as higher spot, higher local premiums, and tighter near-month spreads, and that's where the real pressure starts. Proof point number four, leasing and borrowing costs. In the wholesale market, when someone needs physical metal quickly, bullion banks, industrial users, refiners, they may lease it. When lease rates spike, it means immediate availability is tight or demand for borrowed metal is elevated. Lease rates can be noisy and they can be influenced by multiple factors, but persistently elevated borrowing costs are rarely a sign of comfort. They are a sign that paper says plenty, while immediate access is being rationed. That's a classic paper versus physical tension signal. Proof point number five, the chart structure itself, the way price behaves around round numbers and prior highs. When silver clears a major level, it doesn't just attract discretionary buyers. It triggers hedging behavior. It triggers dealer gamma dynamics. It triggers forced cover in the wrong direction. And those flows don't care about your opinion of fair value. They care about risk. They care about collateral. They care about survival. But here is the twist. The same dynamics that accelerate upside can also accelerate downside when margin hikes or liquidity gaps force a reset. That's why this market whipsaws. That's why you need a psychology shield. Let's talk about the psychology shield now, because this is where most retail investors get harvested. Volatility is not random. It's used, not in a conspiracy sense, more in an incentive sense. Volatility creates emotional mistakes. Emotional mistakes create predictable liquidity. When price rips higher, your brain screams, "I'm late." When it snaps lower, your brain screams, "I'm wrong." Both of those screams are the market on its easiest way to make you do the exact opposite of disciplined behavior. And the market doesn't need to target you for you to be targeted. The structure itself rewards whoever can stay solvent and patient through the swings. So the shield is simple. Separate trend signal from noise. Trend signal is, does the market keep paying up for immediacy? Do spreads stay tight? Does deliverable inventory stop replenishing? Do dips get bought quickly at structurally important levels? Noise is one brutal day in either direction caused by margin, year-end flows, or thin liquidity. If you confuse noise for signal, you'll capitulate right before the next leg. But if you confuse noise for nothing matters, you'll also miss the warning when the setup breaks. The shield isn't diamond hands. The shield is a checklist. Now let's go deeper into why $100 is a consequence. People treat $100 like a forecast, as if someone is drawing a line on a chart and daring the market to touch it. That's not the right frame. The right frame is, at what price does behavior change enough to relieve the constraint? If supply can't respond quickly, price has to do the work. And silver supply is stubborn in a very specific way. A large portion of silver is produced as a byproduct of other mining: copper, lead, zinc. That means higher silver prices don't instantly create a wave of new primary silver production. They may improve economics at the margin, but the mine plan is governed by the primary metal. So in the short run, supply is relatively inelastic. Recycling helps, but recycling is also lagged. People don't instantly turn scrap into deliverable bars at scale just because the screen price moves. Refining capacity matters. Logistics matter. Assay and form matter. Timing matters. So if demand surges or procurement pulls forward, the system can't just make more silver. It has to ration access. What does rationing look like? It looks like higher prices, yes, but more specifically, it looks like higher near-term prices, tighter spreads, elevated borrow costs, rising local premiums, and increased volatility as paper tries to dance around physical constraints. And the next detail is what flips the whole setup. Those are exactly the conditions under which $100 becomes not a target, but a clearing mechanism, because at some point, the market needs a price high enough to do three things at once. One, it needs to slow marginal demand or encourage substitution where possible. Two, it needs to pull forward scrap and secondary supply that otherwise stays dormant. Three, it needs to compensate holders of deliverable metal for parting with it now instead of later. If the constraint is in immediacy, the price that clears the market is the price that buys immediacy. Now bring in the paper market mechanics that make the move look like a rocket. Futures are leveraged, options create reflexivity. Here's the clean version without getting lost in Greek letters. When many call options exist around certain strike prices, dealers who sell those calls may hedge by buying the underlying as price rises. That hedging can create a feedback loop. Price rises, hedging demand rises, price rises more. That's not retail mania. That's structure. Then, when price falls sharply, especially after a margin hike, those hedges can come off, accelerating the downside. Up and down can both be amplified by the same mechanism. That's why your shield matters. But here's why it supports the consequence argument. In a tight physical environment, these paper loops can push price to levels that feel absurd, until you realize they are temporary clearing prices in a stressed system. The market doesn't need to stay at $100 for it to have been a consequence. It just needs to be forced there to clear the bottleneck at a moment in time. Now, the skeptical mind will say, okay, but if silver really had that problem, wouldn't it be obvious everywhere? Not necessarily. This is the thing about modern commodities. Stress often shows up as fragmentation. One region tightens before another. One form tightens before another. One delivery location tightens while the headline, global supply, looks fine. That's why global comparisons matter. If local premiums rise in key demand hubs, if import behavior shifts, if stockpiles in major venues draw down, if lease rates spike, if backwardation appears, those are the fingerprints of tightness. You don't need every venue screaming at once. You just need the marginal venue that sets the clearing price to feel it. And when it does, the rest gets pulled by arbitrage. Arbitrage is the quiet force that makes this whole machine coherent. If silver is priced meaningfully different between venues after adjusting for currency, shipping, financing, and form, someone has an incentive to move metal or paper exposure to capture the spread. But arbitrage is not instantaneous. It's constrained by logistics and credit. And when arbitrage is constrained, price differences can persist longer than people expect. That's another way consequence pricing emerges. If metal can't flow fast enough to equalize prices, the expensive venue stays expensive. That expensive venue becomes the signal. And if that venue is tied to futures delivery or industrial procurement, the signal becomes a driver. Now, there's an important sanity check here. Not every tightness story ends with a moonshot. Sometimes markets resolve by demand destruction. Sometimes they resolve by policy changes. Sometimes inventories get mobilized from places you didn't expect. Metal that was eligible becomes registered because the price incentive is strong enough. Sometimes volatility itself flushes out speculative length and buys the market time. That's why we're going to hold this with a two-scenario lens, because credibility isn't saying up only. Credibility is knowing what would confirm and what would invalidate. Scenario 1 is the controlled pullback and retest. In this scenario, the spike into the 80s was the market's first recognition of stress, and the margin-driven dump was the forced reset. Price pulls back, it tests a key zone, and it holds. The zone to watch is the mid-70s, call it roughly $74 to $76. If silver can hold that area on closing basis, and if rebounds are sharp rather than labored, it suggests that the forced selling did its job but didn't remove the underlying demand. In that case, you watch for the next push toward the prior high area around 83 to 84. And here is the micro detail that matters. If price approaches that high, and the market doesn't immediately collapse again, it implies the collateral and positioning overhang has been reduced. That's when continuation becomes more likely. But the next detail is what flips the whole setup. You don't just watch price. You watch whether the stress gauges stay elevated during the pullback. If spreads remain tight, if backwardation persists, if borrow costs stay high, if deliverable inventory doesn't replenish meaningfully, then a pullback is not relief. It's a coil. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the market doesn't give clean entries. It reclaims $80 quickly, it pushes into the prior highs, and it starts to gap on thin liquidity, especially around year-end and early January flows. If that happens, the path to $90 and even a tag of $100 becomes a sequence of forced events rather than steady buying. Shorts cover because their risk models demand it. Dealers hedge because option exposure demands it. Funds add because momentum and benchmarks demand it. Industrial users panic procure because procurement policies demand it. And when multiple must buyers appear at once, price jumps. That's not the market predicting 100. That aces the market clearing a problem at whatever price it takes. Now the obvious question is, what would invalidate the whole $100 as consequence thesis? There are a few clean invalidation signals you can actually use. One is a structural breakdown below key support that holds for more than a quick flush. If silver loses the low to mid-70s and starts closing below roughly $70 with heavy volume and no sharp recovery, that suggests the demand that drove the spike was more fragile than it looked. Another is a clear easing of the stress gauges. If the curve relaxes back into comfortable contango, if near-term premiums collapse, if lease, borrow costs normalize, if deliverable inventory meaningfully rebuilds, then the immediate constraint is easing. Another is a macro shock that strengthens the dollar and drives real yields sharply higher in a way that crushes the entire complex, especially if it triggers broad risk-off liquidation. That doesn't mean the long-term story dies, but it can diffuse the near-term consequence path. And if the China export narrative softens materially or is implemented in a way that doesn't T-restrict availability, that removes one accelerant. But that's not the part that matters most. What matters most is whether the market can roll its paper exposure comfortably again. If the paper market regains comfort, consequence pricing gets postponed. Now, you might be thinking, okay, but $100 still sounds like a stretch. Good. Skepticism is healthy here, because silver is the kind of market that punishes certainty. But here's the rational frame. $100 is not a guarantee. It has a threshold where constraints are more likely to be addressed through price than through supply response. Think of it this way. If deliverable supply is the bottleneck, the market needs a price high enough to coax holders to release metal and to compensate for the risk of letting go. It needs a price high enough to pull forward recycling and secondary flows. It needs a price high enough to force substitution where feasible. If $80 doesn't do it, the market tries $90. If $90 doesn't do it, it tries $100. Not as prophecy, as process. And the market will overshoot and undershoot because that's how it finds the clearing price under stress. That's why you will see brutal down days even inside an up thesis. That's why you don't anchor to a single candle. You anchor to the mechanism. Let's tie the mechanics back to the institutional behavior you can expect, because this is where consequence becomes visible. When margin rises, leverage longs often have to reduce. That can look bearish on the screen. But simultaneously, industrial hedgers and procurement teams don't operate on margin in the same way. If they fear availability, they care less about a $5 pullback and more about supply certainty. They will buy dips, they will lock in forward contracts, they will diversify sourcing, and they will be willing to pay a premium for metal they can actually obtain. That's why paper dumps sometimes fail to produce sustained downtrends in tight physical environments. The paper can be forced out, but the need remains. And that's where the real pressure starts. Also, institutions that run systematic strategies often rebalance around month-end and year-end. They may reduce winners, add to losers, and reset exposures for the new year. Commodity indices rebalance, funds adjust. This isn't a story about secret cabals. It's a story about mechanical flows that hit predictable dates. When those flows collide with an already stressed market, they can create one of two things: a temporary flush that sets up a bigger move, or a volatility explosion that tags levels faster than anyone expects. The calendar doesn't predict direction by itself. It amplifies whatever stress is already there. Now, before we get to the next 2 weeks checklist, I want to make the most important warning of the entire video very clear. You can be right about the mechanism and still get emotionally destroyed by the path. Silver can whip around violently even if the thesis is correct. The market can drop 10% in a day, then regain it, then drop again. That's not proof you're wrong. That's proof you're in a leveraged, reflexive market. The way you survive that is not by pretending it won't happen. The way you survive is by defining what you were actually watching and what would actually change your mind. Because if you don't set those rules, volatility will set them for you. And volatility's rules are designed to make you buy high and sell low. So here's your near-term roadmap. What comes next, what to watch, and what levels matter, without pretending anyone can time this perfectly. First, watch the mid-70s zone. If silver stabilizes above roughly $74 to $76 and starts printing higher lows, that's the market absorbing the margin shock. That's the market proving there are buyers who are not purely leveraged tourists. If that zone breaks cleanly and stays broken, your near-term risk rises fast. Second, watch $80. It's psychological, it's structural, and it's where hedging behavior often changes. A reclaim of $80 that holds is a signal that the liquidation phase is fading. Third, watch the prior high zone around 83 to 84. If silver retests it and then rejects violently again, the market is telling you it still has too much leverage to carry. If it retests and consolidates under it, tight range, shallow pullbacks, that's when breakouts become more credible. Because if that one level breaks and holds, the math changes. Now watch the stress gauges that don't care about headlines. 1. Deliverable inventory behavior. You're not looking for a single day move, you're looking for trend. Does registered replenish meaningfully, or does it stay constrained? 2. The near-month spread behavior. Does the market keep paying for immediacy, or does it relax? 3. Borrowing and leasing conditions. Are they staying elevated? 4. Local premium behavior. Do you see tightness expressed in availability and pricing off screen? 5. Policy and trade implementation details. Do export controls tighten or loosen? And how does the market react to the reality versus the rumor? But that's not the part that matters most. The part that matters most is how the market reacts after bad news. In a stressed bull setup, bad news stops pushing price down for long. Margin hikes cause a dump, then the market stabilizes quickly. Negative headlines hit, and price shrugs. That shrug is the tell. In a fading setup, every bad news item triggers cascading selling and rebounds become weak and slow. That's your confirmation and invalidation in behavior, not in wishful thinking. Now I promised you the clean payoff. Why $100 is consequence, not prediction, in one tight chain. Here it is. Deliverable supply is the constraint. The curve and borrowing costs are the early warning. The calendar is the accelerant. The paper market is the amplifier. When those 5 line up, price is forced to a level that either mobilizes metal or destroys marginal demand. That level can be far above what feels reasonable. That level can be $100 in a stressed moment. Not because it must happen, but because if the stress doesn't ease, the market doesn't have another peaceful way to clear it. And that's where the real pressure starts. So what should you do with this? Not a trade instruction. A framework. If you're a short-term watcher, you respect the volatility regime, and you don't confuse forced selling with thesis failure. If you're a long-term watcher, you focus on whether the market's stress gauges are easing or tightening, and you treat price whipsaws as the cost of admission in a reflexive market. Either way, your job is not to predict the next tick. Your job is to watch the mechanism and refuse to be emotionally rented by the tape. And here asks the quiet warning. Most people only learn the expensive way. If this setup is real, volatility will be used against you more aggressively than the average bull market. You'll see top calls after every spike. You'll see bubble headlines after every new high. You'll see crash fear after every fast pullback. The goal of that information storm isn't necessarily malicious. It's structural. It's how narratives chase price. But the effect is the same. It tries to shake you out right before the market forces the next adjustment. Your shield is the checklist. Your shield is knowing which signals matter. Your shield is staying aligned with mechanism over mood. If you made it this far, you're already doing the thing most participants refuse to do. You're retracking the plumbing, not the slogans. That's the edge. Keep it. And if you want to build a smarter crowd around this, people who can disagree without falling into hype, drop one comment with the single stress gauge you are watching most closely this week. Registered inventory, near-month spreads, lease rates, or the 74, 76 support zone, $6. Because if we're right, the next 1 to 2 weeks won't be quiet, and the people who survive it won't be the loudest. They'll be the most disciplined.